Good afternoon and welcome to the Boring Millionaire podcast. My name is James Lamantia and my mission is to not only make you money with the stock market, but to teach you about the stock market so that way you can make this money all on your own. So today is Saturday, April 19th, and to look at the week that we had in the stock market, first of all, it was a shorter week. We were closed for Good Friday, so we were only open Monday through Thursday. However, it was a little bit of a boring week. But there's nothing wrong with that. It's in fact a pretty good thing that it was a boring week. The past 3 weeks have been filled with news and filled with excitement, depending on your perspective on things. But there was a lot going on, so a quiet week in the market this week is nothing that I am upset about. So what we saw looking into this boring week was we basically traded in a new range that we see in the market. So through that massive decline, we fell all the way down to 48.12 on the S&P 500, and we had basically bounced around between 48.12 and 52.22 while we were at those lows. So that's a trading range, and we went between those two metrics for a couple days, and what we saw on those trading days was a double bottom. So exactly like it sounds, if you hit a low, trade up a little bit, and then hit that low again and don't go below it, that creates a floor. And what the floor means is basically the lowest spot that the market should be going. So we saw that double bottom create that floor at that 4,800 level. Then on 4.9, we saw the historic pop after the tariffs were paused, and we had gone up and closed at 54.51. So that created a new trading range for us to look at. So between Thursday and Friday of 2 weeks ago, and then this past week, we saw us basically bouncing around between 52.68 and 54.51. So again, a new trading range. So what that tells me is that we're basically walking up the staircase out of this market decline. It's a slow pace, but it is a pace that's moving to higher premiums on these stocks. So again, I just want to reiterate, I am a buyer still at these levels. I do think that the worst is over, and I do think that we're seeing very many signals in the market that's telling me we are going to go higher inevitably. We're not going to see more massive declines. We're not going to see a lot more turbulence. However, you have to prepare for all routes, but everything that I'm looking at is telling me we will continue to move higher. Some of the things that I have been looking at is, first of all, those trading ranges. In this mid-tier trading range, we are now between, like I said, 54.51 and 52.68, and we created another double bottom within that range. So the Thursday after 4.9, which would be 4.10, we did see a sell-off off of that historic pop, but we established a low from those new highs. We saw the high of the lower range at 52.22, and we saw the low of this new range at 52.68. What I look for in stock trading analysis, the stock nerd stuff I refer to it as, is the old highs became the new lows. So the old ceiling became the new floor, and that just screams positivity for trading analytics. And that is another reason why I believe we're going to continue moving higher. I would like to just get off my topic for a second. You could see that same metric on a bigger scale. If you look at 2021, the height of the market at that time was roughly 4,800. So through this massive decline that we're seeing now in 2025, the lows were 4,800. Again, the old highs became the new lows. Just standard trading analytics, and that is telling me that we are going to continue moving higher. On the smaller scale, we did do another double bottom in this mid-range. I would like to see us first cross that 54.51. If we could go above 55.02, that's an even stronger sign. And then I do think that the signal we're looking for, or the metric we're looking for after that, would be 57.51, which is the one-year average. Now, all of these numbers are in reference to the S&P 500, the S&P 500 being the general measurement of the stock market, but that is the metrics I'm looking at. And if we could continue to go above these numbers and hold these numbers, each one is just another signal screaming, yeah, we're getting better, the market's improving, continue to buy because we're going to see all-time highs sooner or later. I do think a touch sooner. I don't think a week or two, but I think maybe in 3 to 6 months we will be back at all-time highs. So what I do want to say too is he did pause the tariffs for 90 days, and that would bring us into the middle of July that these tariffs would resume. So the stock market, the news surrounding the stock market, and the sentiment around the stock market could entirely change by that time. Let's say in July, he says, yeah, the tariffs are going back into place exactly as we were planned. The market's going to be in a totally different position, as well as this really is news that the market has already digested. With that said, my point becomes, I don't think if he decides to assert them again in July, we're going to go right back down to 4,800. We have a lot of time until then. We have a lot of market trading until then. So really, just a hypothetical, as I said. But what I'm looking at too is a lot of the economic data that we've been seeing over the past couple weeks. So inflation has been cooling for March, and it was also cooled in February. So I did mention in a previous episode that trajectory is showing us inflation is cooling. We didn't just get one lucky month. It's consistently going down. So an ultimate positive for the economy. Another ultimate positive for the economy is for 2 months in a row, we were adding more private sector jobs than what the street had anticipated. So we're adding more jobs. We're seeing everything come down in price, all positive for not just the economy, but it will translate into positivity for the stock market as well. Another very valuable point that we saw in this week was there was a Fed meeting on Wednesday, and Fed Chair Jerome Powell came out and he did tell us that they're basically sticking to their plan. They're looking to cut rates still in 2025. However, they may not be sure exactly when that is. They didn't say that they were putting the brakes on it. They didn't say they were changing their mind and raising rates. What they were saying was, let's just see where the market goes. He also made a particular point of saying this news is short-term news in the stock market. They didn't think that this was going to be a long-term effect on the stock market. Of course, Jerome Powell and the rest of the Fed chair, they are not future tellers, but it's pretty relieving to hear that they don't think that this is going to be very impactful news for the long term anyway. So very happy to hear all of those things. Another positive signal that I saw in the market was that the volatility index had fallen back under 30. So 30, I had mentioned, was the high prior to this decline. And the fact that we broke through it, I know I mentioned in a previous episode, there was no rationale to the VIX being that high, almost as there was no rationale for the S&P and the rest of the market to be as low as it was. The market had more sense as far as trading analytics and why we hit some of the levels that we hit. But the volatility being above 30 just was irrational, impractical. And the fact that we went back below 30 is telling me things are shaping up. I would also like to say we were trading in a narrow range for the past 4 days this trading week, and then Thursday, Friday of the week prior. So for 6 trading days, we basically went back and forth between 2 levels on the S&P 500. However, in that same time frame, the volatility index had just continued to deplete. So at the start of this past week, it started at 45. However, it ended under 30, whereas the S&P is actually lower for the week. So my point in all that becomes, even though stocks basically stayed the same, fell just a touch, the fear factor and volatility and animosity in the market continued to decrease. So just again, another great positive indicator telling me that the market will continue higher and that we will, see record highs inevitably. Again, just saying I am a buyer at all these levels. I know I was preaching about buying heavy at these market lows during all the turmoil, but they're still valuable stocks, and the point still remains. They're great companies. They're cheaper than they were 3 months ago. They're cheaper than they were 6 months ago. So what has changed? The company has not changed, just the price of their shares has. One more point I want to make about kind of moving into better market environments is that we are entering earnings season. Last week I mentioned that the banks, they kick off earnings seasons, but we are now seeing new news come into the market. And that's important because all of the news about the tariffs and all the news about just the negativity in the stock market will start to be forgotten about as earnings news comes in. That's what people will be focusing on. Investors at an investment firm putting $100 million into the stock market, they're caring about what's going on right now and what's going on in the future. This tariff news, it's already in. It's basically already over. Like I said, he could implement them again in July. He may not. We don't know that until July, but it's not going to be fresh news. Now investors are focused on fresh news, and that fresh news is going to become earnings season, how these companies are performing, and what their forecast is for the rest of the year. So important earnings this week. We have Tesla on Tuesday. We have Alphabet on Thursday. Those are 2 of the Mega 7. Very important to watch. Other important stocks I'm watching for their earnings this week is AbbVie, Comcast, Boeing, Chipotle, Merck, PepsiCo, and Verizon. All major staples in the world. I'm sure everybody has heard of most of them, if not all of them. So again, just to reiterate, you don't have to worry about buying stocks. You're buying companies that basically create the society that we live in. So I'm watching all of them. I'm very excited to see what these companies do. I would love to see all positive earnings and all positive forecasts and them just beat earnings left and right, because that would certainly put more positivity and more eagerness and incentive to purchase stocks. Obviously, to the contrary, if they were saying everything's poor and we're not really confident about the year looking forward. I do expect some companies to say that the anticipated tariffs may play a negative role on how their business is conducted. But let's just throw a theory again out here. Let's just say now in April, a company like Caterpillar, they say, hey, we're really nervous about tariffs. That might negatively affect us moving forward. They put out bad forecasts, the stock falls. All right, in the near term, that's not necessarily great, but you could buy the discount. And then the next quarter in July, when they say, hey, actually the tariffs never came in place, so all that bad forecast is just wiped away because it's not even a thing now, the stock will play catch up and rally hard. So, I don't want to anticipate stocks doing bad then good. I would rather them be good, but you have to prepare for every avenue, and that is a potential avenue. And I'm just shining light on the theory that some stocks may put bad forecasts out now at the start of the year, and then by mid-year, the third quarter after that, they could say, hey, we were actually wrong about all these negative anticipations, and now here's what we're looking at actually in front of us. So important earnings to continue looking at. They're not this coming week, but to keep in mind, the Mega 7 are the most important earnings reports that we could really look at. So I mentioned Tesla and Alphabet are this coming week. Apple and Amazon are both on May 1st. Meta and Microsoft are both on April 30th. And then NVIDIA is way later in May on May 28th. So they typically try to group them together. NVIDIA, being late to the club of trillion-dollar companies, never got grouped with them as far as when their earnings come out. But they are usually earlier in the earnings season too, because being that they're trillion-dollar companies, if they all move massive ways, that will dictate how the market moves, quite frankly. And I do think if a lot of these stocks, the trillion-dollar stocks, they're playing catch up and they have good forecast, I think Tesla's going to kill earnings because it's just been beaten up on bad PR, basically. So I think they're going to have good forecast. Their numbers are going to be in line, if not better than what people are expecting, and they're going to run. So if all the trillion-dollar companies run upward in a strong fashion, that will ultimately lift up the S&P 500 and the stock market in general. So important earnings to watch. I really have my eye on them. But as far as companies I'm buying this week, I am buying 5 particular companies. And the way I'm buying these companies is with $50. So I'm taking that $50, I'm splitting it up into 5 equal $10 increments. And the first $10 is going to be put into Simon Property Group. Simon Property Group, they are a real estate fund, or a real estate company, I should say, and they actually own Oxford Valley Mall. So for my local audience, we all know Oxford Valley Mall, and you may have noticed that they've been beginning to build those apartments and condominiums and whatever else they have in there. However, it's a ray of hope for companies that own the malls because they're realizing the malls are dead. They are dying. They're basically dead at this point, and they're using the property and real estate that they actually own and adapting to the world that we're living in. So happy to see that. They pay a 5.6% dividend. And if interest rates come down in the near-term future, even the long-term future, they are a direct beneficiary of that. So I love Simon Property Group, always been buying it. My next one is AbbVie. So AbbVie is one of the leaders in pharmaceuticals. I'm buying AbbVie because they're basically at the lows that they were 3 months ago, and they pay a 3.8% dividend. So another fantastic dividend, earning you income just for ownership of those shares. But with AbbVie having earnings this weekend, I'm almost playing the earnings at this point. I anticipate them to have positive earnings, and I think they're going to return to their 52-week high, and I think they're going to run after that. So I'm a buyer of AbbVie. My next one is MasterCard. So MasterCard is one of the strongest stocks you will ever invest in. It is one of the most consistent stocks as far as constantly gaining. Not to mention, every credit card, debit card, every payment method essentially is under MasterCard or Visa. So I'm a buyer of MasterCard. It has traditionally outperformed Visa. So though the two are identical in the space that they're involved in, MasterCard as a stock does typically perform better. So I'm buying MasterCard, sitting at its 1-year average. I always mention that the 1-year average is a very good spot to be purchasing stocks at, and they do pay a 0.6% dividend. So not as lucrative as the first two, but you are still getting paid for ownership of those shares. My next pick this week is Coinbase. It's at a 1-year low. They do not pay a dividend. However, Coinbase is the leading broker in crypto. With crypto becoming more adaptable and usable in the modern day world, with an administration that is pro-crypto, I think it's important to be involved in Coinbase as well as crypto in general. But Coinbase is the very surface level, easy way to be involved without actually being involved. So I would be a buyer here. And then Netflix is my last pick with my last $10. I'm very excited about Netflix. They had their earnings on Thursday and they beat earnings. So first of all, during all of this tariff turmoil, they really outperformed the S&P and the rest of the stock market. They barely fell. They returned to their highs, and that's showing great strength in the stock just on that metric, but then they totally beat earnings. So I have a feeling that Netflix is going to be one of the first stocks in this environment to be breaking new all-time highs, and it'll become a leader in the market in this next 3 to 6 months. So I'm a buyer of that. That also does not pay a dividend, but getting 5.6 and 3.8 is going to make up the difference in not having dividends on these two stocks. So that's my pick for this week. I'm very excited for the week ahead. Again, I do think we're going to continue moving higher. I am a constant buyer at all of these levels, and feel free to shoot me any questions you may have about the market, what I'm buying, and what you think you should be doing with this market environment. You can find me on Facebook, Instagram, TikTok, and just shoot me a message. I'm here for all your stock market and financial needs. So thank you for tuning in. I'll see you next time.